What's up everybody? Nate here. So the Federal Reserve just released a massive report on their plans to tackle inflation and interest rates in 2022. They basically had an emergency meeting in February to go over what they're going to do with interest rates and inflation this year. And they essentially laid out every bit of their plans for 2022 in their brand new minutes report. And for the first time in a very long time, it looks like things are finally starting to happen from the Federal Reserve. According to their report, they are finally ready to start raising interest rates in the United States. And they also laid out plans of how they are going to shrink their balance sheet that has grown to be around $9 trillion in assets from the past 2 years. So today I want to talk all about the brand new major updates from the Federal Reserve, what they're going to mean as far as interest rates and the stock market, and what it's all going to mean for the United States economy in 2022, and how it will all ultimately affect inflation. But before I get into all of that, do me a quick favor and hit, smash, or destroy that thumbs up button below, and ring that notification bell too. Both of those two things are completely free, and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. Now let's talk all about what is new in the Federal Reserve's most recent statement. So the first thing we need to talk about here is interest rates. Everybody has been wondering if interest rates are going to start going up and by how much they're going to go up this year. The Federal Reserve is now eyeing super high interest rates in 2022 and beyond. They said in their most recent report that they were actually planning on raising interest rates at a faster rate than they did back in 2015. And back then, interest rates actually went up pretty quickly because our economy was in a really good place to do so. If you remember, this actually made former President Donald Trump super unhappy, as he thought interest rates were getting way too high, way too quickly. Now, what exactly does that mean? Well, they're now eyeing raising their interest rates by around 50 basis points or more in 2022. And they said this will be completely warranted because the United States economy is either nearing or at right now what they consider full employment. Full employment basically means that anybody in the United States that's able to work is working in our country. The Federal Reserve said, quote, many participants commented that they viewed labor market conditions as already at or very close to those consistent with maximum employment. Meaning the Federal Reserve believes that this is as close as we're going to get with maximum employment in the United States right now. And this new meeting strongly indicated that their first rate hike is coming in March. Now their next major meeting is supposed to happen in the middle of March, around the 15th and 16th of this year. They still didn't say how many times they're going to raise rates in 2022, but most Fed officials say that at least 3 rate hikes or more are coming this year. And if they're around 50 basis points each, that means the United States economy and investors can expect their interest rates to go from around 0% all the way up to 1.5% by the end of 2022. That's still a little lower than expectations are right now, but pretty consistent with what Wall Street has been saying for the past year. We know that inflation is getting bad, and we know the Federal Reserve needs to get super aggressive with it, or else prices and wages are gonna be out of control. Now, what that actually means is with interest rates going up, people in our economy are gonna have a lot less access to money. Demand for money and things is going to go down. It's gonna be harder to get an auto loan or a mortgage if you can't afford it because the interest rate is so high. This would be a complete flip from the Federal Reserve right now though, because most were expecting the Federal Reserve to only raise interest rates around 2 to 3 times this year at a basis point level of around 25, which means interest rates would go up from around 0% to 0.75%. Well, instead, they're gonna go up almost nearly a full percent. That could constrict markets all throughout the world because one, it's gonna be harder for investors to trade on margin. That's basically borrowing money from an exchange in order to make a trade right now. It's gonna be harder to do that if interest rates go up. Not only that though, buyers are gonna be pretty much taken out of the housing market because it's gonna be really difficult for you to afford a mortgage if the interest rate is going up. What that means is paying hundreds of additional dollars on your mortgage every single month. lot of Americans can't afford that right now, especially with rising inflation and rising taxes in our country. But in general, it means that it's gonna be harder for people to spend a lot of money because most of your credit cards are also adjustable when it comes to their interest rates. So people who have been pouring so much money into their credit cards right now are gonna have to pay a ton more in interest. And we've seen credit card debt grow at a faster rate over the past few months than it has in over 22 years. So as of right now, the Federal Reserve hasn't really done much with interest rates. And like I said, they're not expected to raise their interest rates until March. In the report, they said that's when they want to start making those big changes in our economy. So with that being said, look for spending to be restricted and constricted in the United States over the next few months. The next thing we need to talk about is the Federal Reserve's balance sheet. So like I said at the beginning of this video, the Federal Reserve has racked up a balance sheet of nearly $9 trillion due to its quantitative easing program. Starting in about March or April of 2020, the Federal Reserve entered the New York Stock Exchange and started to buy hundreds of billions of dollars worth of assets on Wall Street every single month. And to this day, they are still doing that. They were buying mortgage-backed securities, treasury bonds, and corporate bonds every single month in order to push up the market and help with an easy transition throughout the past couple of years because of the pandemic and inflation. That's in a response to one of the fastest stock market crashes we have ever seen in pretty much stock market history. Now, in this report, they laid out ways that they're going to start decreasing their balance sheet in 2022. Over the next 30 days, the Federal Reserve will be purchasing $20 billion in treasury notes and around $30 billion in mortgage-backed securities. They have been decreasing the amount of assets that they've been purchasing since about December of 2021, as they believe the economic conditions are right for them to do so, and our economy is starting to recover. They also mentioned that most of the participants in this meeting actually were hoping that the Federal Reserve would have voted to end the program a lot sooner, but as of right now, they're going to continue it at least for the next month. That means for the New York Stock Exchange, you can see a lot of these securities and assets continue to get pushed up because you're going to have billions of additional dollars being pumped into Wall Street. So that money isn't going to disappear overnight like a lot of investors were expecting with this new meeting. So as far as the asset purchasing, not really much has changed there, but what this means for Wall Street in general is that this free money is pretty much going to go away after the next 30 days. I mean, it's pretty much guaranteed at this point, with most of the participants in this Fed meeting saying that they would have rather it ended right now. That means in part that investors are going to have to be a lot less risky in the things that they're buying because they're no longer going to be trading with Uncle Sam's dollars. They'll only be trading with their own money. They don't want to lose their own money, so they're not going to be trading those super risky assets anymore. So Wall Street could get squeezed a little bit, but most of them are actually anticipating this, and it didn't really hurt the stock market after this news was released. Right now though, because they're only really buying $20 billion in treasury notes and $30 billion in mortgage-backed securities, it's going to encourage a lot more risky investing in the housing market. So with all of this money being poured into mortgage-backed securities, the value of those securities is going to continue to rise, at least for the next 30 days. Banks and financial institutions have their money pooled in these securities, and those securities go up depending on if the housing market is doing well. With the housing market continuing to explode and interest rates continuing to stay at nearly 0% for at least the next 30 days, the mortgage-backed security market could continue to rise. And it could mean that banks and financial institutions push home buyers to spend a little bit more than they're able to, so that way they can squeeze a few extra dollars of equity and cash into these mortgage-backed securities for investors over the next 30 days. What it also means though is that once that money disappears, the Federal Reserve won't be completely backing the housing market anymore. They've poured so much money into this mortgage-backed security market that they basically have funded the entire 2021 housing market. In 2022, that's going to not continue. So the only thing that's going to be funding it is new home sales and investor cash. And finally, they couldn't have left this meeting without at least mentioning the elephant in the room, inflation. In fact, inflation was brought up a whole 73 times in this new Federal Reserve report. And this is the scariest part from the report. The Federal Reserve now believes that inflation is spreading way faster than they could have imagined, and it's starting to affect way more than than just pandemic era sectors. So going back to 2021 for just a minute, when inflation was just starting to rise in our economy, the Federal Reserve was super adamant that inflation was purely transitory. It's going to go away once our economy starts to improve and our supply chain issues get better as well. From Federal Reserve Chairman Jerome Powell to Treasury Secretary Janet Yellen and even the President of the United States, Joe Biden, everybody was saying that our inflation problems are all transitory. They are nothing to worry about and they're gonna go away. However, by November and December of 2021, that narrative changed. Chairman of the Federal Reserve, Jerome Powell, basically said that we need to retire the phrase transitory, meaning this inflation is not going away anytime soon. The Federal Reserve said, quote, "Participants remarked that recent inflation readings had continued to significantly exceed the committee's longer run goal, and elevated inflation was persisting longer than they had anticipated, reflecting supply and demand imbalances related to the pandemic and reopening of the economy." So inflation just continues to get worse and worse, far beyond even what they anticipated. In fact, in January 2022, inflation went up at its fastest rate in over 40 years and is now sitting at around 7.5%. We haven't seen inflation nearly that high since the late 70s and the early 1980s, when inflation was around 11 to 13%. Still, they want to get inflation down to a level of around 2% this year. In order to do that, they're hoping the interest rate hikes, the pulling of their economic stimulus, and reaching maximum employment gets them there sooner rather than later. So now with all of that being said and the report out there, what does this all mean? How are all of these changes going to shape up for the Federal Reserve and our economy in 2022? Well, the biggest report from this one to the last one is how the Federal Reserve is talking about their interest rates. It's been known for a long time now that they might raise their interest rates in March of this year, but we didn't know the actual magnitude of those rate hikes. Now we're starting to get a feel for how the Federal Reserve is going to take action on inflation, and it could be dramatic. Like I said, raising interest rates that high that quickly means a lot of different things. It means that Americans are going to have less access to money. That's the first one. It also means that Americans are not going to be spending as much, which is bad for the housing market, the auto market, the stock market. If earnings reports on Wall Street start to decrease because Americans are constricted by inflation and they can't spend anything because of the Federal Reserve, well, now you don't just have a bad situation in our economy, you have a near recession. The only way our economy works is if people are going out and spending money. If money isn't circulating throughout our economy, then businesses can't grow. Employers can't pay employees. That is a rough situation, but the Federal Reserve right now wants to do everything they can to lower inflation. The biggest problem for me, though, is why aren't they doing that? They keep saying we're going to get aggressive on inflation. We're going to use all of the tools we have available. Well, then in my opinion, do that. They even mentioned in the report that a lot of the participants wanted to end quantitative easing earlier, but they just don't do it. And the reason for that is because the Federal Reserve does not want to be the bad guy here and does not want to scare the American public. They don't want to pull their money too quickly because that's going to scare the stock market. They don't want to say that inflation is way too high right now. We're going to raise interest rates by 1 basis point every single time, 5 times this year, because that would crash our economy. We're talking past a recession. That could be depression level. If the United States population knows that the Federal Reserve is scared and our United States federal government is scared about inflation and they can't really do much, well, then that is going to tank our economy because now Americans aren't going to go out and spend with confidence. They're only going to buy things that they need. And then they're going to ultimately save the rest. So the Federal Reserve, in my opinion, is moving way too slow here. But even with all of that being said, and the Federal Reserve doing its best next month to take down inflation, there's ultimately a ton of conditions that the Federal Reserve can't control. You see, the Federal Reserve and our federal government can't control, for one, supply chain issues. We live in a free market economy. The federal government has very little say over what our businesses do and how much they supply and pay their workers. With that being said, if the federal government has no control over it, then what does it matter about the policies that they make? Fact of the matter is, it doesn't, which means the Federal Reserve is going to raise its interest rates while still battling a supply chain issue situation that's not really their fault. So even though the Federal Reserve is going going to lower demand, we're still going to be facing supply chain issues because of things like the Great Resignation and the anti-work movement. Millions of Americans over the last few months have been quitting their jobs voluntarily. We can't actually reach that maximum employment level because people don't want to work right now. I mean, granted, there are millions of Americans that want to work, but what they don't want is their labor to be exploited. And they don't want to work for wages that basically mean nothing at the end of the day. If inflation is still going up and you're getting paid at your job, but your income doesn't really meet inflation, well then what's the point in working? Millions of Americans have been finding that out, so they're just quitting their jobs in search of a better one. That has put strain on businesses, and ultimately the Federal Reserve can't really control what businesses do. Not only that, but our supply chains are controlled by factors that are oftentimes outside of the United States. We have a Russia-Ukraine situation that is boiling over right now, and that could mean that energy prices and commodity prices go up because of sanctions that could be imposed on the United States very soon. That is, if Russia actually does invade Ukraine. They haven't done that yet. It looks like they might be open to talks, but nothing is set in stone as of recording this video. And that situation becomes infinitely worse if China decides to back Russia in this situation, because I don't know if you've noticed, we get a ton of materials from China. The Federal Reserve has no say over that. They don't have say over our global economy. They can only control what happens in our borders. But the fact of the matter is they're going to do everything that they can, and they're going to couple that with businesses not raising wages enough, not treating their employees well enough, so supply chain issues continue even though demand starts decreasing in the US. That's going to hit your stock market. That's going to hit the housing market. That's going to hit the auto markets, and it's going to hit Americans' pockets because inflation is still going to be going up. So what I'm basically saying here is that even though the Federal Reserve has a lot of things that they want to do in 30 days from now, it may be way too late for the Federal Reserve to do anything about this rising inflation, at least without causing a complete recession. Because yeah, Federal Reserve can lower demand and lower their stimulus to a point where it's impossible to buy things. That might cause a recession, but the question is, does the United States need a recession right now in order to lower inflation? Well, that might be the case, because even though our GDP and our economy is showing signs of improving, the only reason it's improving is because people are spending so much money right now. They're spending so much money because of inflation. So all of those numbers are pretty much artificial, and they're way higher and more elevated than they should be. A recession is basically 2/4 of economic shrinking in your country. So we may need to shrink down to a normal level before we can start growing at a regular pace again. So this is a really tough situation for our United States economy and the federal government, but here is what you need to know. Nothing can go straight up forever. Over the past 2 years, we've seen asset prices in the stock market and the cryptocurrency market go through the roof. We've also seen prices in the housing market and auto markets and pretty much every market in general go way up. None of that can last forever. Our economy is booming and is overinflated right now. Things in our economy are eventually going to have to come down, which means risky investments and all of this money printing and spending just cannot continue if our economy is going to remain stable. This is something the Federal Reserve talked about in its report and is worried about for the future of our economy: financial stability. In order to keep things stable, though, you have to ride the fine line between doing way too much and doing way too little. And I just don't think the Federal Reserve is going to find that middle, which means our economy is in trouble in 2022 and beyond. Do I think a full-on crash is coming? Well, I honestly don't know yet, because we don't know what's going to happen with our supply chains overseas. We don't yet know what's going to happen with the Ukraine-Russia situation. If both of those two things actually start improving, then our economy could start to go in the right direction. And if businesses start treating their employees better and paying their employees more, then that could mean the Great Resignation improves as well, and our anti-work movement starts to lose some steam. All of that means that maximum employment is being achieved in this country, with an unemployment rate that goes down, which means people are making a lot more money, which means they can spend more too. That's a good situation to be in for the Federal Reserve, because just like in 2015, they can then start raising interest rates because Americans are in a good situation to do so. However, the Federal Reserve cannot raise interest rates that aggressively and pull a lot of their money printing if our economy is not in a good position. If they do so too early, then that is going to be a problem, because not enough Americans are working right now and there's just not enough money to go around because of inflation. You're then gonna go from way overspending to no spending at all. That's bad, because then they're gonna be in the same position they were back in March of 2020. Do they bail out the economy or let it fail? And I can guarantee you that the free money policies and money printing will come back. Of course, if that happens, there's no guarantee that that is going to happen just yet. But what I can tell you right now is kind of the perfect storm is brewing in the Federal Reserve and our economy right now. There's nothing the average American can really do except for prepare themselves. Because 30 days from now, our economy could look a whole lot different than it does right now. But now I want to hear from you on this issue. What do you think about this brand new announcement from the Federal Reserve? Do you think that they have done quite enough about inflation already and that they can just ease off for the rest of 2022? Or do you think that they need to get aggressive no matter what in order to lower inflation? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. I hope you liked this video. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. If you want to stay up to date with me and everything else happening in our business and financial world, I'm putting out videos 7 days a week over here, and I've got a video ready for you right now that you can check out before you go. Thank you so much for watching. Be kind out there, and I'll see you all in the next one.